Let's do another one, adding a little bit more complexity. This time we're going to have inventory that we have to deal with. And remember, if you have inventory, the question is, do you want to track the inventory on a perpetual inventory system within QuickBooks or on a periodic inventory system, possibly tracking the units of inventory outside of the QuickBooks on Excel or possibly on another website like your Shopify store or Amazon, for example. If you have a Shopify store or Amazon, we have another course or section getting into some details on that. But let's give a general idea as though we're tracking inventory within the system. So let's go ahead and add another item. This will be let's say a sales receipt again. And let's say this is going to be for customer 2. Customer 2, I'm just going to put generic customer 2. And let's make this one on the 8th. And let's say the payment this time, imagine we're going to get paid with a credit card. And this time, since we're going to get paid with a credit card, the credit card company is not going to deposit each sale item into my checking account, but most likely group multiple sales items when it hits my checking account. Therefore, I can't just put it into my checking account. I'm going to put it into the clearing account of undeposited funds. Similarly, if you got cash, because you might make multiple sales, you're not going to put the cash sales directly into your checking account, but rather undeposited funds so you can transfer it with a deposit form. So we'll see that process. Let's add an inventory item. Inventory item number 1. And so I'm going to add the item inventory this time. We're going to track it internally, which means a perpetual inventory system. I'm going to say that there's 5 units on hand. If I say there's 5 units on hand, it's going to record a transaction putting the units on hand, 5 units times however much the cost is, and it's going to increase inventory by that amount. I'm going to put the as of date, let's just put it as the 4th, and reorder point, I'll put 0. So when inventory gets down to 0, we will reorder. Inventory is the asset account that will increase when we buy it, decrease when we sell it. We are selling it here. Inventory item 1 is going to be the name, sales amount. Let's say we sell it for $50 or $200 this time. And the income account, when we sell it, is going to be sale of products and services. Let's apply the sales tax, which in the United States is a type of consumption tax, similar to what you might have in other countries. So let's say it's going to be taxable this time. So it'll apply the tax, and then we're going to say that the sale purchase description and the cost when we buy them for, let's say, 150. We buy them for 150. We sell them for 200. Let's save it and close it. All right. So let's say that we just sell one of those. We have 5 on hand now because we recorded the 5 on hand when I added the item. It's subject to tax. So what's this going to do? So it's like an invoice, except instead of accounts receivable going up, we got paid, but we put it into not the checking account, but undeposited funds. That's for the full amount, including the sales tax, $216 in this case. The other side's going to go to revenue account, which is driven by the item here, which is going to be the sale of product revenue on the income statement, but that's only for the $200, not including the sales tax. The $16 sales tax is going to go into a liability account, some kind of sales tax payable, and we're going to have a decrease to the inventory, not for the 200, but I believe the 150 for the cost of the inventory and cost of goods sold. The expense for us consuming the inventory is going to go up. Net impact on net income sales price of 200 minus the cost of goods sold of 150. And we're going to have the subledger for the inventory, which is going to be tracking by units, which will be impacted for the sale as well. So let's go ahead and save and close it, and then we'll check that out, go into the balance sheet, and let's run it. And so now we put it into undeposited funds. So if I go into undeposited funds, there's the 216. If I go back into that, that's for the full amount, including the sales tax, closing that out, tabbing, or let's go back here, tab to the right to see the income statement, running it. And now we have the income of the 200. Notice the 200 here does not include the sales tax, which was $16. That difference is back on the balance sheet, and it's in the liability side for the Board of Equalization, because that's like sales tax payable that we have to pay to the government. And there's the $16. So there is that. Now, just a quick note here. You could imagine a situation where we put the full on the income statement, we put the full amount of $216 on the income statement, right? And then we deduct the 16 in taxes, and we'd get to the same amount. But the government wants to say, well, you're not the one paying the tax. The customer is. You're just the collection person. Therefore, instead of recording the revenue of $16 and then the expense of us paying the sales tax of $16, we put the $16 on as a liability, increasing the liability and then decreasing the liability when we pay it is the general idea. All right, and then we also have the inventory going down. So here's our inventory, and this is recorded in dollars. There's the inventory. There's the 150. Remember that the 150 is not on the sales receipt, but driven by the item in the sales receipt. Let's go back, and then back to the income statement. We have the 150 in cost of goods sold for us selling the inventory. Back to the first tab, we also have a subledger for inventory now, tracking this information. So let's go to the first tab and the reports. And then I'm just going to type in inventory valuation summary. And we'll take a look at that. Let's put it as of the end of the year, 12/31/25, just to make sure we cover everything. And there it is. So now we've got 4 units remaining because we put 5 units on the books and then sold 1. And then the total amount of the subledger, $1,196.25, should tie out to what's on the balance sheet, $1,196.25. All right, let's go back to the first tab and let's do one more transaction for the sales receipt. And so we're going to say sales receipt. And this time let's put customer 4, let's say. And I'm just going to add it. And this happens, let's just say on the 8th. And the payment method, let's say, is Visa again. We're going to put it again into undeposited funds. We're going to say this is a service item. And let's say that we have 3 of those, so $300. This one is simply going to increase the undeposited funds this time. Instead of the checking account, the other side go into revenue, service revenue. Let's save it and close it. And let's go to the balance sheet now. So now we have undeposited funds. Let's refresh the balance sheet before I get into that. Undeposited funds should have gone up by that amount. So let's go back. It's not there yet. It's being glitchy. Let's go into it. QuickBooks is usually pretty good. Sometimes this sample company file is more like kind of glitchy sometimes than the actual QuickBooks I have found when you buy it, possibly because multiple people are logged into it or something. Let's go to the tab to the right, run it again, and then we see in the sale of product, we should have that item in here, and here's the service item, the 400 now. All right,